Under significant pressure is Dixon Tech. Puneet joins in with a bull versus bear on this one. We've spoken and we've taken Mr. Chokalingam's view, but this is going to be an interesting one. Puneet.
Well, thanks for that. So definitely the stock is under pressure today, and while there's not any particular fundamental reasons, we look at what's the bull case as well as the bear case scenario for a stock like Dixon Technologies. While we have seen a strong run up of about 168% in the past year, some correction at a very high valuation is what being seen today. But when you look at the first bull case scenario is of course the electronic components PLI scheme that's expected to be announced over the next couple of months. There is an outlay of about 25,000 crores that's expected as per media reports, but it will be a beneficiary for something like a Dixon as well as the other players in the EMS space as well, because that's expected to boost margins significantly, and Dixon will be one of the biggest beneficiaries because more than 80% of the revenues come from the mobile segment. And as per a report by Nomura, they have mentioned that additions of components in the mobiles that they manufacture currently will increase EBITDA margin dramatically, and the bill of materials essentially will go up from 11% to 27%, and essentially boost revenues by almost double currently or what they are expecting. But on the bear case scenario is of course the low margin mobile business that is the lion's share of the revenue currently. For FY24 basis, it was almost 80%, and brokerages are estimating this to grow to 88% of their total revenues because of decent growth in the other segment, but the hyper growth in something like a mobile segment as well. So that's going to be one of the key things to watch out for, with the components PLI being one of the biggest positive triggers going forward as well. When you look at the second bull case as well as the bear case scenario, is continuing with the mobile theme, that mobiles are expected to have, that Dixon Technology is expected to have a 30% market share in India for all mobile phones manufactured. Essentially 3 out of 10 mobile phones manufactured will be done by Dixon Technologies, despite having more than 19 players that manufacture mobiles in the country. Apart from that, home appliances segment has been one of the key segments that has degrown, and that's one of the issues because the hyper growth in something like a mobiles has not been followed up by the other segments. Hence, the margins have been around the 4% range of the total revenues. When you look at the third bull case as well as the bear case scenario, it's talking about a larger share of revenues coming from components going forward. That's what the company has estimated. While on the bear case, they have mentioned that they will not be looking to enter the semiconductor space for any kind of manufacturing. That's something like a Keynes Technology has already called out, and that's essentially leaving 50% of any kind of components that are manufactured within an electronic item. So the company has steadfastly said that they will be looking at the non-semiconductor components, which is roughly 50% of the total cost of any kind of mobile phone or refrigerator. Well, they might be restricting themselves to that. They're essentially looking to increase the share from that non-semiconductor component. Finally, on valuations, that is of course currently at heightened pressure. But brokerages are estimating that revenues from the current level of 16,000 crores will go up by 5x to almost 80,000 crores by FY27. That's the biggest bull case coming in. But current valuation at 200 times price to earnings might be pricing in some of that. And if the EBITDA margins don't come through over the next 3 years, that will be one of the key disappointments, because the other players have already moved to a 7 to 8% EBITDA margin price range, while Dixon currently is at 4% because of the high share of mobile. So that's something that we try to encapsulate with the trigger being the electronic components PLI. But essentially strong revenue growth projected over the next 3 years. Would margins follow is the key question to watch out for.
Well, margins is something we look out for on the fundamental side. We've obviously taken views from Mr. Chokalingam as well. He's spoken about how risks also need to be built into some of these valuations. But Shivangi, let me come to you on some of these names with regard to EMS. Any of them looking interesting on charts, and what's happening today? You're seeing some of these really getting beaten.
Absolutely. We've seen, good names like Dixon, breaking more than 8% intraday. And we've seen that there has been a sharp sell-off in most of the names. Overall, I believe till the time Dixon holds above 16,500, it is still, lucrative to add positions here. This is a level of the upward sloping trend line on the weekly basis. It's also, nearing its 50 daily exponential moving averages, but we will have to, I believe, wait for some more time for this short covering move to again, favor this stock. But overall, this is the strongest out of the entire pack, and this should be kept in radar to utilize at these dips.
Okay, so that's the technical check also coming in on some of the EMS plays. Let's take a short break. On the other side, we're going to get you top buy today, sell tomorrow picks. So stay tuned.